You are looking for the secret weapon. You are looking for the formula, the algorithm, the hidden line of code that will finally make the market predictable. And so you turn to the indicators, you layer the MACD over the RSI, you stack the Bollinger Bands, you try to find congruence between the stochastic oscillator and the volume profile. You are seeking external validation for an internal conflict. You are trying to solve a psychological problem with mathematics. Stop. Look at your screen. If your chart looks like a Jackson Pollock painting, a chaotic mess of overlapping lines, flashing colors, and conflicting signals, you are not preparing to trade. You are preparing to fail. You are drowning out the market's truth with noise. The premise of this video is brutal but necessary. The moment you introduce an indicator, you are intentionally handicapping yourself. You are delaying your success. Why? Because every single indicator you have ever used is fundamentally, mathematically, and irrevocably flawed. They are the lagging lie. Think about the calculation of a simple moving average. It is, by definition, an average of what price already did. It is historical data. It is the rearview mirror. You are trying to drive a Formula One car looking only at where you have been. A professional pilot never navigates a storm using only the turbulence they just experienced. They look forward. They look at the raw data of pressure, wind speed, and altitude. The intermediate trader, the one stuck in that painful cycle of profitability followed by devastating loss, clings to indicators because they offer the paradox of comfort. The market is chaos. Price moves randomly in the short term, and that randomness terrifies the human mind. Indicators provide a false sense of order. They give you a signal, a line crossing another line, a neat little arrow that says now. This illusion of control is deeply comforting. It mitigates the immediate terror of subjective decision-making. But that comfort is a poison. It destroys objective clarity. When the market is clearly trending up, your RSI is overbought. What do? The indicator tells you to sell, but the price action tells you to hold. You hesitate. You doubt. You are paralyzed by confirmation bias. You have trained your brain to look for a mathematical excuse to enter a trade instead of looking for the undeniable truth of price action itself. The intermediate trap is the pursuit of complexity. You believe that if you just find the right combination of 5 indicators, the magic cocktail, you will unlock consistency. So you spend weeks optimizing settings, backtesting complex systems, and building elaborate visual filters. What are you really doing? You are building a psychological fortress to avoid confronting the raw truth of the chart. You are afraid of the price. You are afraid that if you strip the chart bare, you won't know what to do. You are afraid that the simplicity will expose your lack of discipline, your impatience, and your fear of missing out. You are using the tools as a scapegoat. If the trade fails, it wasn't your fault. It was the MACD divergence that fooled you. This is the definition of intellectual cowardice in trading. The problem is not the tool. The problem is reliance on the tool to solve an internal conflict. Indicators are crutches for the fearful mind, and crutches prevent you from ever learning to walk on your own. You are looking for an indicator that predicts the future. That indicator does not exist. It cannot exist. The only indicator that matters is already on your screen. It is the raw, unfiltered movement of price itself. It is the clearest, most immediate, and least manipulated data point available to you. But you have trained yourself to filter it out, drowning it in 50-period moving averages and convoluted histograms. We are going to strip the chart bare. We are going to delete every line, every oscillator, every mathematical distraction. We are going to look at the raw truth. And when we are finished, you will realize that the simple strategy is 10 times better because it removes the psychological friction between you and the market. It forces you to move from prediction to reaction. The first step in this journey is accepting the responsibility that comes with clarity. When you remove the indicators, you remove your excuses. This is where the ego resists. The ego loves complexity because complexity suggests expertise. If I am using a sophisticated algorithm with proprietary settings, I feel smart. If I am simply looking at a candle sticking out of a clean zone, I feel exposed. The market doesn't care about how smart you feel. It only cares about execution. Moving from prediction to reaction is the psychological shift required to become a professional. Indicators try to predict. When the fast line crosses the slow line, the future will be higher. This invites arrogance and over-leveraging. Professionals react. Price just broke structure, confirming momentum is shifting. I will enter here with defined risk, and if the market invalidates my thesis, I will exit. It is humble. It is mechanical. Why is the simple strategy so hard to adopt? Because it demands that you accept responsibility for every single outcome. When you trade a bear chart, there is no scapegoat. If you enter too early, that's impatience. If you hold too long, that's greed. If you miss the move, that's fear of missing out. You are facing yourself in the market's mirror. The simple strategy is built on one single undeniable principle: price structure. The market is not a random walk. It is an auction driven by supply and demand, and that auction leaves a trail. That trail is structure. The market only speaks two languages, and they are visual. One is the trend up, characterized by higher highs HH and higher lows HL. The other is the trend down, characterized by lower lows LL and lower highs LH. This is the market's language. This is its DNA. Every single indicator you have ever used, RSI, ADX, MACD, is just trying to mathematically describe whether the market is currently making HH, HL, or LL, LH. They are trying to summarize the conversation. We are going straight to the source. Understanding momentum purely through structure requires no mathematics. When a higher low is broken and price closes below it, that is a structural break. That is a shift in the balance of power. The angle and speed of that break tell you everything about the conviction behind the move, the flow. You don't need a momentum oscillator to tell you the trend is strong. You can see the aggressive, fast momentum candles smashing through previous structural points. The power of nothing on your chart is immense. When you remove the noise, you remove decision fatigue. You stop trying to reconcile conflicting signals. Your focus narrows to the only thing that pays: price, structure, and location. A bear chart forces you to wait for the undeniable. It forces you to wait for the market to scream its intention, rather than trying to decipher its whisper through layers of complex algorithms. If you removed every single indicator right now, what would your conviction be based on? Would you even know where to place a stop loss? Would you know where the last point of institutional defense was? We are going to build that conviction from the ground up. We are going to learn to read the market's skeleton. We are going to define the only two things the market ever does. It expands or it contracts. It trends or it consolidates. And structure tells you which one is happening right now. This is phase one, the geometry of supply and demand. This is where we define the technical backbone of the simple strategy. The market moves in waves. Every wave has a peak and a trough. These are your swing points. These are the hinges upon which the entire market turns. A swing point is not an arbitrary high or low. It is a point where the market, after a period of expansion, reversed and broke a preceding counter-trend structure. It is the pivot where the previous group of participants failed. When price successfully pushes past a significant swing point, that is a structural break. This is the key distinction you must internalize. Is the break a change of character, chalk, signaling a potential reversal, or is it a confirmation of trend, T, validating the existing momentum? A change of character happens when price breaks the last major higher low in an uptrend. It is the first sign that the buyers have failed to maintain control. It is a warning shot. A confirmation of trend happens when price successfully makes a higher high, validating that the buyers are still in control. It is an affirmation of momentum. If you can only define these two events, CHOCH and COT, you have already bypassed 90% of the complexity that traps intermediate traders. You know exactly who is winning the auction. Now we must identify the locations where these structural breaks matter most. These are the clean zones. Clean zones are true supply and demand areas. They are based on clear institutional turning points where a significant move originated or where price reacted violently before. They are not arbitrary lines drawn by a pivot point indicator. They are the undeniable evidence of large orders being filled. A clean zone is easy to spot. It's the area immediately preceding a massive structural break. It is the last point of institutional accumulation or distribution before the market committed to a new direction. Why do traders fail with fixed levels? Because price reacts to areas, not points. The market is not precise enough to respect a single horizontal line down to the penny. It is reacting to a concentration of orders. A clean zone gives you the necessary buffer. It gives you the space to understand that the market is testing the liquidity in that area before making its next commitment. If you are using indicators, you are looking for a trigger. When you use structure, you are looking for context. Structure dictates the market environment. Is the market trending? Look for clean HH/HL or LL/LH. Is the market consolidating? Look for failed structural breaks where price is trapped between two clear recent structural points. Is the market reversing? Look for the change of character followed by a successful retest of the broken structural level. This structural analysis replaces the need for trend-following indicators like the ADX or the parabolic SAR. You don't need a mathematical description of the trend. You can see the trend in the geometry of the candles. To confirm a structural break, we use the rule of 3. This is your filter against false breakouts and noise. First, price close. Did the candle close decisively beyond the structural point? A weak wick poking through is a warning. A full body close is commitment. Second, volume context. Was the break accompanied by higher than average volume? This confirms institutional intent. We will expand on volume shortly. Third, time frame alignment. Is the break on the 5-minute chart happening in the direction of the 4-hour trend, or is it merely noise? Every indicator you ever loved, the stochastic, the MACD, the momentum index, was just trying to describe these structural points mathematically. They were trying to tell you, the price is making a higher low, but we'll call it oversold for you. We are skipping the middleman. We are reading the source code. We have defined the market's skeleton, its structure. Now we must define its breadth, volume, and time. Volume is often misunderstood. Retail traders use it as a momentum indicator. Professionals use it as a measure of institutional intent and commitment. High volume at a structural break is confirmation. It tells you that the large players agree with the direction. It is the sound of conviction. If price breaks a major higher low with aggressive candles but low volume, that is suspicious. It suggests manipulation or a lack of real institutional backing. It is a warning of exhaustion. Volume is commitment. If a major supply zone is tested on low volume, the supply is weak. If it is tested on massive volume and price still fails to close above it, that zone is defended by massive institutional commitment. You do not need an on-balance volume indicator or a volume profile overlay to understand this. Simply look at the raw volume bars below your chart and compare the current commitment to the average commitment. The time component is the ultimate confirmation filter. The market is fractal. What happens on the 5-minute chart is noise if it contradicts the 4-hour trend. If you see a beautiful structural break signaling a short trade on the 15-minute chart, but the 4-hour trend is undeniably making higher highs and higher lows, your 15-minute signal is likely a short-term retracement within a larger bullish auction. The alignment of time frames is non-negotiable. Your entry time frame must be supported by the directional context of the higher time frame. The higher time frame defines the direction of the flow. The lower time frame defines the precise entry risk. If the 4-hour chart is bullish, you are only interested in structural breaks that confirm the bullish momentum, COT, or retests of higher lows. You must filter out every signal that attempts to fight the primary flow. View the market as an ongoing auction process. Structure defines the agreed-upon price. The last higher low was the price floor where buyers last agreed to defend their position. That is the consensus. Volume defines the conviction behind that agreement. If the price floor is defended with massive volume, the conviction is strong. When structure and volume align perfectly, when a major structural point is broken with decisive price close and overwhelming volume, the auction has shifted. That is your signal. The greatest benefit of this simple strategy is the silence of the chart. It teaches patience. It forces you to wait. Because perfect alignment of structure and volume, confirmed by time frame context, happens rarely. Most of the time, the market is messy. It is consolidating, choppy, or offering ambiguous signals. The intermediate trader tries to trade all of it. The professional waits for the perfect, undeniable setup. This strategic waiting is the source of the 10x edge. You are making fewer trades, but those trades carry exponentially higher conviction because the market has done the hard work of signaling its intention for you. Most traders look for patterns. Experts look for context. A triangle pattern is useless without context. A triangle forming at a major 4-hour structural resistance zone, accompanied by declining volume, is a setup. The structure and volume provide the context that gives the pattern meaning. We have defined the market's skeleton, structure, and its muscle, volume. Now we must address the nervous system, the ego that controls execution. The anatomy of a high-conviction trade is defined entirely by quantifiable risk, not potential reward. The entry psychology must shift from a guess to a precise calculation. Your entry is not the point where you hope the market turns. It is the precise point where the structural risk is quantifiable and minimal. In a confirmed uptrend, when price pulls back to retest the previous structural break, the new higher low, your entry is on the confirmation of support at that level. Crucially, the stop loss is defined by structure, not by dollar amount. This is the single most important rule of the simple strategy. Your stop loss is not 50 pips. Your stop loss is the precise location where the structural thesis is invalidated. If you are entering on a higher low retest, your stop loss must be placed just below that structural low. If price hits that stop loss, it means the market has invalidated your thesis that the trend is continuing. The structure has broken. The auction has shifted. When the thesis is dead, the trade must die instantly without emotional debate. Treating the stop loss as thesis invalidation transforms the psychological experience of trading. It removes the sting of failure. It was not a mistake. It was the market proving your initial assessment was wrong and you respected the market's decision. Managing the live trade is the greatest psychological challenge. Once you are in, the market will try to shake you out. It will offer noise, volatility, and deep retracements that make you question your conviction. If you were using volatility indicators, you would be panicked, thinking the move is exhausted. But structure gives you the objective reason to hold. As long as the price does not violate the structural point that defines your stop loss, the thesis remains intact. You must sit still. You must allow the market room to breathe, knowing that your risk is defined by the absolute point of structural invalidation. Targeting and distribution must also be structural. Where do you take profit? At the next clean structural zone, the next high liquidity area where institutional distribution is likely to occur. You are not aiming for the moon. You are aiming for the next logical barrier the market must overcome. Taking partial profits is not done out of fear. It is a systematic distribution of risk. By removing risk at the first major structural target, you lock in capital and turn the rest of the trade into a risk-free hold, freeing up emotional and mental capital for the next setup. The ego trade looks for maximum profit. It chases every pip, holds through every reversal, and refuses to take partials because it believes it deserves the entire move. The structural trade looks for maximum probability. It aims for the high probability structural target, respects the market's barriers, and systematically reduces risk. The difference between the two is consistency. I will show you how the very act of placing your stop loss correctly is the single greatest act of patience and self-control you can perform in trading. It requires accepting a defined loss before the potential for gain, which is anathema to the impulsive mind. The 10x edge is not about a hidden technical trick. It is about psychological clarity. Mastery is monotony. The simple strategy is 10 times better not because it guarantees a higher win rate, no strategy can guarantee that, but because it provides 10 times more psychological clarity, leading to 10 times better execution. When your chart is clean and your rules are based purely on structural breaks and volume, your decision tree is simplified. There is no debate about whether the RSI is diverging. There is only, did price break structure, yes or no? This simplicity breeds mechanical execution, and mechanical execution breeds consistency. The role of journaling becomes critical here. Your trade journal is now your internal indicator. You are not tracking P and L. You are tracking emotional adherence to structure. Did you enter precisely at the structural retest, or did you chase the move because of FOMO? Did you move your stop loss because price got close to it? Did you take profit too early because of fear? Your true edge is not in your setup. The setup is simple structure. Your true edge is in your discipline. The journal tracks the performance of your discipline. The boredom of success is real. If you are constantly seeking excitement in trading, you are seeking chaos. Excitement comes from gambling, from uncertainty, from the adrenaline rush of a high-risk, low-probability trade. Consistency feels boring. The simple strategy is repetitive, mechanical, and therefore profitable. You are waiting for the same structural setup confirmed by the same volume context, on the same time frame alignment over and over again. The market is 90% waiting and 10% flawless execution. If you are bored, you are doing it right. If you are entertained, you are losing money. Risk management must be viewed as protecting emotional capital. Trading losses are inevitable. Structural losses, where the market invalidates your thesis, are part of the process. But those structural losses must not lead to emotional losses. Emotional losses are what happen when you deviate from the structural plan. Revenge trading, over-leveraging to recover a loss, or ignoring your stop loss. Protecting the mind is more important than protecting the account balance. The account balance can be recovered, but a shattered mental state will destroy your consistency for months. The surrender paradox is the final psychological hurdle. To gain control over your trading, you must surrender control over the market. You must surrender the need to be right. The market does not care about your ego. You must surrender the need to predict. You are reacting to structure, not forecasting the future. You must surrender the need for constant action. Waiting is your primary job. This surrender is not weakness. It is the ultimate strength. It is the acceptance of reality, allowing you to move purely mechanically, guided by the undeniable truth of price structure. We have stripped the chart bare. Now we must strip the ego bare. The final step is understanding that the market doesn't care about your thesis. It only cares about your reaction to its structural movement. Let us synthesize the simple strategy. It is reading raw price structure, the clean, observable pattern of higher highs, higher lows, and lower highs. This structure is confirmed by volume, which acts as the measure of institutional intent and commitment behind the structural breaks. And the entire process is applied with stoic discipline filtered by time frame alignment, waiting for the perfect, undeniable convergence of all three elements. The open loop is now closed. The indicator you were missing was the chart itself, viewed without the noise of mathematical interpretation. Indicators are interpretations of the past. Structure is the reality of the present. Your final test, the commitment you must make right now, is this. Go back to your charts, delete every single indicator, clear the screen. Now ask yourself 3 questions. 1. Where is the undeniable recent structural support? Where is the last higher low that buyers defended with conviction? 2. Where is the undeniable recent structural resistance? Where is the last lower high that sellers defended with conviction? 3. Based on the current price relative to those 2 points, is the market trending or consolidating? If you cannot answer those 3 questions cleanly, simply, and immediately, you wait. You do nothing. This strategy requires patience. It requires discipline. It requires the willingness to accept long periods of waiting, sometimes days, for the perfect structural alignment. This waiting is the highest barrier to entry for true success, and it is why most traders fail. They cannot handle the silence. Stop chasing complexity. Complexity is where failure hides. Start mastering simplicity. Simplicity is where clarity resides. The market is whispering the truth to you through its structure. Stop drowning it out with the confusing noise of lagging math. The ultimate indicator is not on the screen, but in the silence between your ears. Master that silence and you master the market.